Hello again, traders. Doing trouble there from Drfx, swing trader mentoring. Going to be taking a look at the trading loss that we were able to avoid on the New Zealand Canadian dollar, as this currency pair reversed sharply bearish based on the weak signal that was given on the forward chart. So I'm going to be taking a look at the overall setup and the overall expectation that we had in terms of a trading opportunity, as well as the warning that I sent out that basically identified this as a market trap and that it would have been too risky to attempt to try and trade the signal that was given. Now, of course, all of my analysis and all of my trading is done within the context of 3 trading setups that are identified and traded each week. The first setup, which is the example given here, and is actually what was being done on the New Zealand Canadian dollar, is where the market would provide us with early indications with bullish and bearish waves that indicate that the market or the currency pair that we're looking at is going to be forming a consolidation setup. So instead of waiting until the market has completed the boundaries of resistance and support and then trading between these boundaries, we would be able to spot early out that the market is going to be forming these setups and trade these early waves until the consolidation has been completed. Because the idea is that by the time we wait until the consolidation has been completed, we may not get additional signals. We may not get tradable signals that we can use to be able to take advantage of these movements. Also, in the case of pennants like this, where the distance between resistance and support becomes narrow, what it means is that the distance and the pip range that we be able to target becomes smaller and becomes riskier to trade. So before that happens, once we're able to spot early out that the market is going to be forming consolidation with these early waves, once the signals and setups on the 4-hour chart and the daily chart are strong and clear enough, then we can take advantage of them until the consolidation has been completed. The second setup, of course, is that once a consolidation has been clearly formed, we would then trade between the boundaries of resistance and support. So we will continue to trade these bullish and bearish waves until the breakout finally takes place either at resistance or at support. And the third setup that is traded is that we trade false breakout reversal setups, where the market will attempt a breakout at one end of the consolidation and then reverse and head back inside of the consolidation. So these are the 3 setups that are traded within the context of the formation of consolidation setups. Breakouts from these consolidation setups are no longer traded, because what I found is that over the last several months and years, these types of breakouts are becoming a lot more risky. Even though they do take place from time to time and do provide profitable trading opportunities, what I found is that the setups and signals to be able to take advantage of them with Japanese candlestick signals are becoming more unreliable. So what I've also found is that movements that lead to the formation of consolidation, normal movements that take place after the consolidation has been completed, as well as false breakout reversals, tend to be the most prevalent market setup that we see across the major currency pairs relative to breakouts. So that is why the focus is simply focus on these 3 main setups instead of waiting until the breakout that may or may not happen and which may or may not provide us with a profitable trading opportunity. Now, to take advantage of these 3 setups and the movements that take place, what is important is that we identify the main types of setups and signals that allow us to take advantage of these movements. So it's very important that these signals are identified and that they are strong enough and that they meet the criteria that allows us to establish them as being these particular candlestick signals. Of course, everything is done within the context of this trading goal, where my goal is to now capture a trading gain of 100% each year. And I believe that trying to capture this trading target on a demo account is going to be ideal in terms of being able to have the level of confidence that you need in order to transition from a demo account to a live account. So you're going to be able to monitor my live account and see how I make the journey all the way down to through these targets until I finally hit the 100% target by the end of the year. Of course, everything is done within the context of this methodology, where within the context of those 3 trading setups that I traded, what is done is to actually use a daily chart and a 4-hour chart to identify trading opportunities and to capture trading gains of between 50 and 70 pips within 24 hours. Where justified, trading gains of between 40 and 50 pips will also be targeted by my methodology. As I said before, daily chart and a 4-hour chart used to identify market direction and entry opportunity, entry signal to take advantage of these movements are done with the signals provided by the 4-hour chart. To protect the trade, stop loss areas on the 4-hour chart are also used, but where this is not possible, the setups and signals provided by the 1-hour chart are then used to protect the trade. Now, to be able to identify what is taking place on the currency pair that we're looking at, it is very important that we follow these 8 steps in order to be able to clearly identify what is taking place, to avoid market traps, as well as to identify profitable trading opportunities. So once these 8 steps are followed religiously, then it puts us in a better position to be able to identify the best trading opportunities and avoid market traps that lead to unexpected losses. Now, turning to the New Zealand Canadian dollar, this was the setup on the daily chart where, based on the bullish and bearish waves that have been formed so far, the expectation was that the market was going to continue with these bearish and bullish waves to eventually form a pennant consolidation setup. So with the U-turn taking place this week with this bullish signal, it was expected that we would rally, and in so doing, we will be looking for a trading opportunity on the 4-hour chart to take advantage of this expected movement. Now, as part of this U-turn that took place, the 4-hour chart, as you can see here, got things going with this double bottom formation and the break of this downtrend line. So these 2 strong signals combined with the strong breakout that took place towards this area here indicated that what was needed now was for the market to provide us with an additional bullish signal to confirm the continuation of the movement and provide us with a strong trading opportunity. Now, as the market began to provide us with the expected signal, what was needed was for the market to provide us with the bullish signal, but not just any bullish signal. It had to be of a certain size in order to have a high probability of actually leading to the expected breakout. If it fell short of this expected size, then it actually had a low probability of actually working out. So this was the expectation in terms of the size of the candle that was required, and this was the setup assuming that the market was going to be giving us the signal. So this was taking around half an hour before the candle was going to close, and this would have been the entry price, and this would have been the target to capture the trading gain as the market headed towards the resistance area. Now, as you can see from this snapshot of the email that was sent, you can see that I'd warned that basically that the market needed to close at these prices in order for the candle to be strong enough. Otherwise, if it closed below that, then the trade would have a low chance of actually working out because the candle was going to be weak. So, and as you can see here, the market, instead of providing us with the signal that was needed, it closed with a weak candle here. And so with this weak candle, what was expected or what was possible was that the market would pull back and then form a consolidation setup and then provide us with another bullish signal. So this was the expectation based on the fact that the market had provided us with this weak signal that was too risky to try and trade this long. And of course, this was the email that was sent out to you that basically said that the signal was too weak and that it was possible that the market was going to be forming a consolidation setup. And as you can see here, it was a good thing that we actually spotted this signal, this weak signal, as the market, as you can see, reversed and took out all of this bullish movement that took place 12 hours before. So this was another example of being able to spot these weak signals, despite the fact that the market had a strong chance of rallying. But these are the market traps that the market sets for us at the last minute that can make the difference in terms of a profitable trade and an unexpected reversal and trading loss. Now, as I've said before, there are certain types of candlestick signals that tell us that the market is going to be providing us with a profitable trading opportunity. Anything that falls short of that signal is going to be very risky. There are times when these smaller signals do work out, but in most cases they do not, and it is really not worth the risk to actually try and trade these signals. So as you can see here, these are the types of candles that generally lead to profitable movements, and in most cases what we find is that the normal candles, these tend to be the ones that lead to the most profitable trading opportunities. Larger candles like this also sometimes lead to profitable movements, but they are, to trade these and for them to be profitable, these are more dependent on the setup and the scenario that is being traded, that would determine whether or not these can be profitable. Because these can also indicate that the trend is going to end or that a reversal is going to take place. So depending on the context where these signals are provided, it can either be a risky setup or a profitable setup. But anything smaller than this in size, in these two, smaller than these candles here, have a very low chance of actually working out and providing a profitable trading opportunity. So I've categorized them in terms of normal candles and large candles, as I just showed. And I also speak about the weak candles, which is what we saw on the New Zealand Canadian dollar. So the weak candles are to be avoided. Again, sometimes they lead to profitable movements, but because of the greater tendency of these to lead to reversals, it is generally not worth the risk in terms of trying to trade these types of signals. So in summary, the expectation on the New Zealand Canadian dollar was that it was going to be forming a pennant consolidation setup based on the nature of the bullish and bearish waves that have been formed. But because of the weakness of the signal provided on the 4-hour chart, despite the double bottom signal, despite the break of the downtrend line, it made the overall trade very risky. And as you can see from the warnings that I'd given, this was the right decision to do, to avoid trading this, because of the sharp reversal that took place that would have taken out our trading position in a very short period of time, in a blink of an eye. So of course, if you have any questions, you can hit that reply button in terms of what took place on the New Zealand Canadian dollar. And of course, if you have any questions on this setup or any other setups, you can let me know. And in the next videos, I'm going to be taking a look at the other trading opportunities that the market could provide for us within the next several days.